The banking industry lies at the core of growth of an economy, especially if it is able to extend affordable and accessible credit. Affordability and accessibility are the concepts we're trying to examine and see whether these really apply to Uganda's banking industry.
Uganda has been making efforts to deepen financial inclusion. The emergency of mobile money and of late the rolling out of agency banking are all seen as steps in pushing the financial sector deepening agenda.
The National Financial Inclusion Strategy, spearheaded by Bank of Uganda and the Ministry of Finance, defines financial inclusion as having access to and using a broad range of quality and affordable financial services. Clearly, the above definition encompasses several dimensions of financial services, such as access, diversity of products and services. A cost element is very critical, and financial literacy.
Agents across the country can serve customers of any member bank. And through that, through the numerous outlets, then we can reach out the bigger part of the population, have them, subscribe to services, extend services to the deepest levels.
Bringing services closer to the people through such initiatives is one thing, but having the masses access such services like credit is another issue altogether. Sector players contend that some of the factors making this access together with affordability hard are at times beyond their control.
Now, looking at the US economy and what's happening with interest rates, it matters for us here in East Africa, it matters for us here in Uganda. The US economy is going to raise rates for a total of 4 times this year. We've already seen 2 rate hikes. We're going to see another rate hike in September. We're going to see another rate hike in December. It's going to be 25 basis points each. The market has broadly priced this in, so there's not going to be the financial market instability perhaps of what we saw in 2015. In that process, what's going to happen is your client's cost of borrowing in dollars is going to become exponentially more expensive. Since 2015, as the US central bank's been raising rates, a lot of our corporates in East Africa have dollar liabilities. They have to pay back dollar loans that are pegged on LIBOR, whether it's a 3-month or a 6-month. And if their businesses have not grown, for example, we heard from the Honorable Minister that arrears is a problem, not just in Uganda, but across East Africa. If their businesses are not growing and their dollar borrowing costs are becoming expensive, that is a huge drag and a drain on their businesses.
These factors affect the borrowing rates and interest rates of banks, further shrinking the number of people who can access banking services. This is made worse by relatively high credit rates, which today hover around 20% for non-premium borrowers, pushing up the rate of non-performing loans.
There are people who borrow money, Mr. Prime Minister. They borrow money and they fail to pay it back. Not because they are not capable, but they think it is their right to walk away with the people's money. How? When I give you my money, you must give it back to me. Isn't it right? Is that not what it should be? If I have problems, I come and discuss it with you. That's how we should run the financial systems. You have no right to refuse to pay back money that I have given you to use to run your businesses. If the businesses are having a problem, come back to me. Bankers, I don't know whether you are educating your customers or not.
As banks align their systems to allow in more clients, access and affordability of their services are critical issues that need to be factored into this drive.
Because in this fast world of trying to move as swiftly as possible, in the halls of credit, that over time and in terms of price, that the longer you take for a credit decision on turnaround time, customers are willing to trade off swiftness for a few percentage points, which enhance your credit system. Look, it is always about serving customers and providing the best offering. But time is of essence, particularly in credit. For a micro SME, a day, 2 days is an eternity in terms of the ability to turn around product. So unless you walk and understand that customer experience of how important this is, you've missed it.
Eventually, banks will be required to increase market reach, but the impact of this will be negligible if it goes without deliberate efforts to break the access barriers to financial services, especially affordability.